Silver is not weak. That's the first thing we need to make absolutely clear before we go any further. Because if you look at the charts, if you listen to the headlines, if you watch the way mainstream financial media talks about silver, the conclusion they want you to reach is simple. Silver is underperforming. Silver is lagging. Silver cannot break higher. But that conclusion only makes sense if you are looking at the wrong system. The truth is much more complicated and much more explosive. Silver is not weak. Silver is trapped. What you are watching right now is not a normal market behaving according to supply and demand. It is a market caught inside a structure that has been built over decades, a structure where the paper trading system that sets the price has grown far larger than the physical supply it represents. And when those two worlds begin to separate, strange things start happening. Prices can move in ways that make absolutely no sense relative to real-world demand. Physical metal can become harder to source even as the futures price falls. Premiums in the real market can rise while the headline price remains suppressed. If that sounds irrational, it's because it is. But it's also not new. The silver market has always been unique among commodities because of the way it is traded. Unlike many industrial materials that are priced primarily through direct supply contracts, silver is priced largely through futures exchanges where massive volumes of contracts trade every day. Those contracts represent claims on silver. But the key word there is claims, because the amount of paper silver traded on futures exchanges is dramatically larger than the amount of physical silver sitting inside the vaults that supposedly back those contracts. This is where the math starts to become important. At any given moment, the open interest in silver futures can represent hundreds of millions of ounces of silver, yet the registered silver available for delivery inside exchange vaults is often only a fraction of that amount. In other words, the system functions on the assumption that most traders will never actually request the metal. Instead, they roll their contracts forward or settle in cash. As long as that behavior continues, the system works. But the moment participants begin demanding real metal instead of paper settlement, the structure becomes much more fragile. And that's where things start to get interesting, because over the past several years we have seen signs that the balance between paper trading and physical demand is slowly shifting. Industrial demand for silver has exploded as new technologies require increasingly large amounts of the metal. Solar energy infrastructure alone consumes massive quantities of silver because of its unparalleled electrical conductivity. Electric vehicles, advanced electronics, medical equipment, and high-performance computing systems all rely on silver in ways that were almost unimaginable just a generation ago. These industries are not speculators. They are not trading futures contracts hoping for a quick profit. They need the physical metal to build products that power the modern economy, and that demand is not going away. At the same time, the supply side of the silver market has become far more constrained than most people realize. Unlike gold, which is often mined specifically as a primary product, most silver production comes as a byproduct of mining other metals like copper, zinc, and lead. That means silver supply depends heavily on the economics of entirely different industries. If copper mines slow down production, silver supply can drop even if demand for silver itself remains strong. If investment in new mining projects declines, it can take a decade or more before new production comes online. This creates a structural problem. Demand can increase quickly, but supply responds very slowly, and that imbalance becomes even more important when you consider the way the silver price is actually determined. The futures market sets the headline price for silver. But futures markets are highly leveraged systems where traders can control large amounts of metal with relatively small amounts of capital. That leverage allows enormous volumes of contracts to be created and traded every day. In effect, it allows synthetic supply to be created inside the financial system. When large institutions sell futures contracts aggressively, they can push the price lower even if physical demand remains strong. This is one of the reasons the silver market can appear weak even during periods when real-world demand is rising. The price you see on your screen does not necessarily reflect the tightness of the physical market. Instead, it reflects the balance between buyers and sellers in the leveraged paper market. For years, that system has kept the silver price relatively stable compared to other commodities. But stability inside a leveraged system can sometimes mask deeper structural pressure building beneath the surface. Pressure that only becomes visible when something changes, and that change may be closer than many investors realize. Because when you examine the underlying data, the relationship between open interest, vault inventories, industrial demand, and long-term supply constraints, a very different picture begins to emerge. Silver does not look weak, silver looks compressed. The system that has kept the price contained for so long increasingly resembles a coiled spring. The leverage embedded in the futures market has created a structure where price suppression can continue as long as confidence remains intact. But if confidence breaks, if enough participants decide they want physical metal instead of paper contracts, the adjustment can happen very quickly, and that is where the 280 silver scenario begins to enter the conversation. Not as a prediction based on hype or speculation, but as a mathematical possibility that emerges when you start analyzing what happens if the paper market structure loses control of price discovery. Because when a market moves from synthetic supply back toward physical reality, the numbers can change dramatically, and the math behind that transition is far more powerful than most people realize. To understand why the silver market behaves the way it does, you have to look at the structure that actually determines the price. Most investors assume that commodities trade in a simple environment where physical supply meets physical demand and the price adjusts accordingly. But silver does not operate inside that kind of straightforward market. Instead, silver is priced primarily through financial exchanges. The most important of these is the futures market, where traders buy and sell contracts that represent silver rather than the metal itself. These contracts allow participants to speculate on price movements without ever touching the underlying commodity. At first glance, this system seems efficient. It creates liquidity, allows hedging, and enables global price discovery. But over time, it has evolved into something much larger and more complex than most people realize. The futures market for silver now trades volumes that are vastly larger than the physical supply available in exchange vaults. To see how extreme this imbalance can become, consider how futures contracts actually work. A single standard silver futures contract represents 5,000 ounces of silver. Traders can buy or sell these contracts with only a fraction of the contract's full value posted as margin. This means large financial institutions can control enormous amounts of paper silver with relatively small amounts of capital. The result is a system where the notional supply of silver in the futures market can expand dramatically. At any given time, the total open interest in silver futures can represent hundreds of millions of ounces of silver. Yet the actual registered silver inside the exchange vaults that is available for delivery is often far smaller. This is not necessarily a problem by itself. The system was designed with the assumption that most traders are not interested in taking delivery. They simply want exposure to price movements, so contracts are typically closed or rolled forward before delivery ever becomes necessary. As long as that behavior continues, the system functions smoothly, but the structure becomes fragile if the percentage of participants requesting physical delivery begins to rise, because the vault inventories that support the futures market are not unlimited. In the silver market, the metal stored in exchange vaults is divided into two categories: eligible and registered. Eligible silver belongs to private owners who are storing their metal in vaults but have not made it available for delivery against futures contracts. Registered silver, on the other hand, is the metal that has been specifically designated to satisfy delivery requests from the futures market. When traders talk about available supply inside the exchange system, they are usually referring to registered silver, and that number can be surprisingly small relative to the size of the paper market built on top of it. This is where the concept of leverage in the silver market becomes important. If open futures contracts represent hundreds of millions of ounces, while registered inventories are only a fraction of that amount, it means the paper market is operating with significant leverage against the physical supply. In other words, there can be many more claims on silver than there are ounces readily available for delivery. Again, this structure works perfectly well as long as the majority of participants are satisfied with financial settlement. But the situation changes if enough participants begin demanding real metal. When delivery requests increase, inventories can decline quickly. If inventories fall below certain thresholds, confidence in the ability of the exchange to fulfill contracts can begin to erode. That's when volatility tends to increase. Because once market participants start questioning whether paper contracts truly represent physical metal, the incentive to secure real supply becomes much stronger. This dynamic has appeared periodically throughout the history of commodity markets. Whenever derivatives trading grows much larger than the physical supply it represents, the system can become sensitive to shifts in behavior. If too many participants try to convert paper claims into real assets at the same time, the imbalance becomes visible, and when that happens, prices can adjust very quickly. The silver market has flirted with this type of tension multiple times in the past. During periods of strong investment demand, physical inventories have tightened significantly, while futures prices continued to fluctuate due to trading activity in the paper market. This disconnect between financial pricing and physical availability is one of the defining characteristics of silver trading. It is also why the market can appear weak on the surface even when underlying demand remains strong. The paper market can temporarily overwhelm the signals coming from physical supply. But that influence has limits, Because physical metal cannot be created with a keyboard, it must be mined, refined, transported, and stored, and those processes operate on timelines that cannot match the speed of financial trading. When physical demand increases faster than supply can respond, pressure begins to build within the system. That pressure may not immediately appear in the future's price. Instead, it often shows up first in other indicators. Premiums for physical coins and bars may rise. Delivery times from dealers may lengthen. Inventories inside exchange vaults may decline steadily over time. Each of these signals represents a small piece of the larger puzzle. Individually, they may not appear dramatic, but collectively they reveal a market where physical supply is becoming increasingly important. And in a financial system that has grown accustomed to controlling prices through derivatives, the moment when physical reality begins to dominate again can be extremely powerful, because the paper market may influence the price, but it cannot manufacture the metal. This is why the phrase "silver is trapped" captures the current situation so well. The price is being held inside a system built on financial leverage. That system can continue functioning as long as confidence remains intact and participants behave according to the assumptions embedded within the structure. But the moment those assumptions change, the dynamics of the market can shift rapidly. And when that shift happens, the adjustment between paper claims and physical supply can create price movements that seem almost impossible when viewed from today's perspective. Which brings us to the next part of the equation. Because once you understand the mechanics of the paper system, the next question becomes even more important. What happens when the demand for real silver continues to grow while the supply struggles to keep up? And that is where the numbers behind the 280 silver scenario start to become much more interesting. Once you understand the mechanics of the paper system controlling the silver price, the next piece of the puzzle becomes even more important: the physical market itself. Because while financial markets can expand synthetic supply almost infinitely through derivatives and leverage, the real-world supply of silver is governed by geology, mining economics, and industrial demand. And that reality is beginning to matter more every year. For most of modern financial history, silver has lived in a strange dual identity. It is both a precious metal with monetary characteristics and an industrial metal essential to modern technology. That combination means its price is influenced by two entirely different forces: investment demand and industrial consumption. When both of those forces start rising at the same time, the effect on the supply-demand balance can become dramatic. Over the past decade, industrial demand for silver has quietly entered a new phase of growth. The world's transition toward electrification and digital infrastructure has made silver one of the most important materials in advanced manufacturing. Silver is the most electrically conductive metal on Earth. It is also one of the most thermally conductive and reflective elements available. These properties make it indispensable in technologies where performance and reliability matter. Solar energy systems rely heavily on silver in photovoltaic cells that convert sunlight into electricity. Electric vehicles use silver in power electronics, battery systems, and charging infrastructure. High-performance computing hardware, telecommunications equipment, and advanced medical technologies all depend on silver components. Even the rapidly expanding artificial intelligence industry indirectly increases silver demand because the massive data centers powering modern computing require enormous electrical infrastructure. In short, silver has become deeply embedded in the technologies driving the modern economy. And unlike investment demand, which can fluctuate based on market sentiment, industrial demand is often price insensitive. Companies building solar panels or advanced electronics cannot simply stop production because silver prices rise slightly. They require the material to manufacture their products. That means industrial demand tends to persist even during periods when prices are rising. At the same time, the supply side of the silver market has struggled to keep pace with this expanding demand. Global silver mine production has remained relatively flat in recent years. One of the key reasons for this is the structure of the mining industry itself. Unlike gold, where many mines operate primarily to produce gold, the majority of silver production comes as a byproduct of mining operations targeting other metals. Copper, lead, zinc, and gold mines often produce silver as an additional output. This means silver supply depends heavily on the economics of entirely different industries. If a copper mine slows production due to falling copper prices, silver output may decline as well. Mining companies rarely open entirely new operations solely to produce silver unless the economics are extremely favorable. And even when new mining projects are approved, the process of exploration, permitting, financing, and construction can take a decade or longer before production begins. This slow response time creates a structural constraint on supply. When demand rises quickly, production cannot immediately increase to meet it. Over the past several years, multiple industry reports have suggested that the silver market is entering a period of sustained supply deficits. In other words, the amount of silver consumed each year may exceed the amount produced by mines and recycled from existing products. When deficits occur, the market must rely on existing above-ground inventories to fill the gap. At first, this may not have a dramatic effect on price. There are still reserves available in private holdings, industrial stockpiles, and exchange vaults, but over time, persistent deficits gradually reduce the cushion that protects the market from sudden shortages. And when that cushion becomes thin enough, the market can react very quickly to changes in demand. This is where the idea of a silver price explosion begins to enter the discussion. If industrial demand continues rising while supply remains constrained, and if investment demand increases at the same time due to monetary uncertainty, the combined pressure on available silver could become significant. Now consider what happens if this physical tightness begins interacting with the paper market structure we discussed earlier. Remember that the futures market allows enormous volumes of silver contracts to trade with relatively small amounts of capital. That leverage can suppress price movements when sellers dominate the paper market. But leverage works both ways. If physical demand begins draining inventories while investors simultaneously increase exposure to silver, the futures market may eventually face pressure from the opposite direction. Traders who previously sold contracts expecting stable prices could be forced to cover those positions if the market begins moving higher. That process is known as a short squeeze. Short squeezes can occur in many markets, but they become especially powerful in markets where leverage is high and physical supply is limited. When sellers rush to close positions while buyers are aggressively seeking physical metal, price movements can accelerate rapidly. This is where the mathematical case for dramatically higher silver prices begins to emerge. Consider the historical context. Silver reached nearly $50 per ounce during the 2011 commodity boom. Adjusted for inflation since that period, the equivalent price today would already be significantly higher. But that peak occurred before the massive expansion of renewable energy demand, before the global electrification push, and before the current levels of monetary uncertainty. If the physical silver market were forced to reconcile supply constraints with surging demand, while the paper system lost control of price discovery, the resulting adjustment could be far larger than many investors expect. That is where projections such as $150, $200, or even $280 per ounce begin appearing in market discussions. These numbers are not guarantees. They are scenarios derived from examining what happens when a leveraged financial system collides with the physical limits of a commodity market. In a stable environment, price adjustments happen gradually. But when structural imbalances exist for long periods of time, the eventual correction can be much faster and more dramatic. Which brings us back to the idea that silver is not weak, it is compressed. The system holding the price in place can continue functioning as long as the balance between paper trading and physical demand remains stable. But if that balance shifts, even slightly, the numbers behind the silver market begin to look very different. And that is exactly why investors around the world are watching the silver market more closely than they have in years. Because when a market that has been suppressed for decades finally begins to move, the resulting price discovery can happen far faster than anyone expects. So what actually breaks the trap? Because that is the real question now. Silver has lived inside this leveraged financial structure for decades. The paper market has been able to control price discovery because the majority of participants were willing to trade contracts instead of demanding metal. As long as confidence in that system remained intact, the balance between paper supply and physical demand could hold, but every system built on leverage has a breaking point. The trap breaks when physical demand begins overwhelming the assumptions the paper market relies on. That can happen in several ways. A surge in industrial demand can tighten supply faster than expected. A wave of investment demand can begin draining exchange inventories. Or a loss of confidence in fiat currencies can push investors toward tangible assets all at once. When those forces start interacting at the same time, the adjustment can accelerate quickly. The key signals to watch are already visible. Watch the level of silver inventories inside exchange vaults. Watch the relationship between open interest in futures contracts and the amount of registered metal available for delivery. Watch premiums in the physical market. And watch how industrial demand evolves as electrification and advanced technologies continue expanding worldwide. These indicators reveal the real pressure building beneath the surface of the market. Silver does not appear weak when you examine those numbers, it appears constrained. For years, the price has been determined primarily by the leverage of the paper system. But if physical supply and demand begin dominating price discovery again, the entire structure of the market could shift. And when that shift happens, the math changes. That is why some analysts believe the next major move in silver will not be gradual. It will be explosive. Because when a compressed market finally escapes the structure holding it in place, price does not drift upward slowly. It reprices all at once.